Hello and welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in Forex, stocks and commodities in multiple destinations. I'm Michael Hewson, and after a 3 to 4 week hiatus, joining me again is Pepperstone Senior Market Strategist Michael Brown. Now, Michael, since we last spoke 3 to 4 weeks ago now, I think it was, a lot of water has essentially flown under the bridge. We've seen rate cuts from the ECB, the Bank of England, but the Federal Reserve kept rates on hold. Despite that, the dollar is now weaker. Yields have come off. We've seen record highs for the FTSE100, the DAX, the S&P 500, and everything I think looks still pretty hunky-dory, despite I think a lot of gloom, I think, about the underlying economic outlook in Europe, the UK, probably less so in the US. So, what's been your key takeaways for the last 3 weeks?
Yeah, I think you've hit the nail on the head there, mate, to be honest with you. Let me stress that hiatus was because you decided to go on a very well-deserved holiday. Some of us still had our nose to the grindstone, so to speak, while you were away. But yeah, it has been an interesting spell. I mean, I think the narrative in terms of a macro perspective, certainly here in the UK, hasn't improved particularly much.
Before you go any further, risk warning.
Oh, good point. Yes, yeah, we'll get in trouble otherwise. That's a very good shout.
Yeah, it's a very good shout. I suddenly saw it on the desk in front of me. But I mean, we haven't given any investment advice yet, but I've got to say this. Obviously, you'll get into trouble with your compliance people. So here we go. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own financial advice. Spread bets and CFDs are highly complex instruments and come with a high degree of risk of losing money rapidly due to leverage. 75.9% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Anyway, sorry to interrupt you there.
No, that's very important.
Yeah, very important point. But you were saying, yes, absolutely. Please go on.
Yeah, so I think the narrative on this side of the Atlantic certainly hasn't changed particularly much. Still a lot of doom and gloom here in the UK and also in Europe as well. But I think, it's a great example of how the stock market is not the economy, because we're sat here with the FTSE at a record high, the DAX at a record high, French equities are at their best levels in a year or so. But of course, as we were saying earlier in the week on a call, the vibe in the US where you've been for the last few weeks is very, very different indeed, isn't it?
Oh, absolutely. I mean, it's chalk and cheese in terms of how Americans view the economy. And however you think or whatever you think about Donald Trump as a president, and he does polarize opinion pretty much across the political spectrum, Americans love their country. They talk their country up, irrespective of who's in charge. And whatever you think about Trump, whatever you think about the people he has in his administration, they talk the economy up. And it trickles down into the rest of the economy. You compare that to the approach of the government here in the UK, and ultimately they've been talking the economy off a cliff. Now, not surprisingly, that's going to filter down into consumer confidence. It's going to filter down into retail sales spending patterns, and it's going to filter down into GDP. And we've seen that pretty much in the economic data that we've seen over the course of the past 3 or 4 weeks. And I think there's one thing that really, really aggravates me about this country. It really does. Americans are immensely proud of their country, immensely proud of it. Whatever its faults, they're proud to be American and they're proud to show they're American. We're almost ashamed to be British, ashamed of our history, ashamed to be English. I say apologise for nothing. Talk yourself up. If you talk yourself up, you're capable of great things. The US has proved it. Why can't we follow suit? Why do we always have to talk our country down?
Yeah, no, I think you're absolutely right. And, without wishing to get overly political, of course, but, the GDP data that we had out this morning, the economy grew
Mm,
by 0.1% in the 3 months to December. That's a rounding error. The economy's gone nowhere for 6 months. But it's
mm.
absolutely, as you say, the government have come in, they've talked down the economy, they've depressed consumer confidence, they've been speaking about this £22 billion black hole that supposedly existed. Then there's talk of tax rises, spending cuts, they get delivered. Obviously, business is going to get battered in April with the national insurance changes, and now there's reports that they need to go further because their headroom has been effectively wiped out. So there'll be more government spending cuts on the way, and it's just an example. And sadly, it has happened here, and the economy is stagnating. But it's an example of how rhetoric can turn into an eventual outcome, and that's exactly what we've seen. Effectively, policymakers talking the economy into a hole that it's now going to be quite difficult to get out of.
Yeah, and obviously then implementing fiscal measures that exacerbate that doom loop, if you like, or
Mm.
that negative spiral. And you talked about the growth forecasts and Rachel Reeves' fiscal headroom. We talked about the rise in bond yields at the end of last year. Now, the decline in bond yields since then has bought her a little bit of respite. But
Mm.
ultimately, this leak from the OBR about the fact that her fiscal headroom is gone because they're downgrading their growth forecast. Well, who could have possibly foreseen
Yeah.
that? Um, puts us back to where she was 3 or 4 weeks ago when yields were higher.
Yeah,
So,
no, you're
so
absolutely
where are
right.
we?
Well, we're stuck between a rock and a hard place is where we
Mm,
are, and it's not only, of course, the OBR that have downgraded their growth forecast. The
mm,
BOE last week slashed their 2025 growth forecast in half, and at the same time as doing that, they raised their CPI forecast from what was, I think, 2.7%. They now see inflation peaking at 3.8% in the third quarter of this year. So,
mm.
a very, very grim outlook indeed from Governor Bailey and co. Basically saying less growth, higher inflation than we've previously been expecting. And it's really unsurprising that you get such a forecast when you've got inflationary measures coming through in the budget and also higher energy prices that are going to feed into the figures as well.
Yeah, which sort of brings me on to the recent decisions by the Bank of England as well as the ECB to cut rates. Now, ECB cutting rates, not a surprise, nothing to see here. Moving on, European rates are a lot lower. I think what was really surprising for me was not the fact that the Bank of England cut rates by 25 basis points, not the fact that essentially Swati Dingra argued for a much bigger 50 basis point rate cut. What was surprising to me, I think, was the fact that Catherine Mann
Mm.
joined her. Now, they were opposite ends of the rate hike cut debate this time last year.
Mm.
Swati Dingra has been calling for rate cuts since the base rate went above 3%. Well, we're well north of that now. And now Catherine Mann has joined Swati Dingra in the dovish camp. And her comments, I think, earlier this week clarified matters to some extent. I think she acknowledged that monetary policy was way too tight or restrictive, and that while calling for a 50 basis point rate cut was a significant shift in her stance, it didn't mean that she was open to much more aggressive rate cutting, if that makes sense. It was a
Yeah,
sort of like a one and done type thing.
yeah, it's a very odd one, and
Yeah.
I'm not sure either the bank or her have done themselves many favours by how this has been communicated. I think probably the best way to frame it is, yeah, man, this is the first time she's actually voted for a cut this cycle. I think what she's trying to communicate is the level at which she thinks rates should be at, as opposed to portraying a more dovish path for policy going forwards. Because, as you said, she voted for a 50 basis point cut, but at the same time said, there are still signs of inflation persistence. It's not guaranteed that we're going to get back down to 2%. And also, she was talking about how she thinks that it's still necessary to maintain a restrictive policy stance. So I agree. I think this is a case of, yes, the February meeting, man has gone from uber hawk to uber dove. She's probably going to go somewhere back towards the more hawkish side over the next few months, particularly if we don't see signs of inflation persistence fading. And of course, we've got a very busy week of data next week, but
Mm,
including the latest price figures as well on
mm.
Wednesday.
Yeah, UK CPI, I was going to sort of segue onto that. But, before we sort of moved on to that, I wanted to sort of talk about the FTSE 100. Now, at the end of last year, I posed a question to you, but I also posed a question to Fiona at City Index and Chris Beecham at IG about FTSE 100 going to 9,000. Now, at the time, we were at 8,200, so we're halfway there virtually, which I must admit I'm a little bit surprised at so early in the year. But I think it's entirely possible now. We got to 8,830, I think, earlier this week. So only 170 points to go.
Well, yeah, I mean, it was certainly a sort of ambitious target when we were talking about it last December. But you're right. We're halfway there, and we're 6 weeks into the year. Hasn't time flown? The momentum is certainly to the upside at the moment, and this is clearly no reflection whatsoever of a massive sort of bullish belief in the UK economy, but nonetheless, it's a sort of case of a rising tide lifts all boats, really, and the FTSE is just tagging along with that move, and that does look like it could continue for the time being, at least.
And on your earlier point, the stock market isn't the economy. And on that note, I want to touch on some of the numbers that we've seen out this week. We've seen numbers out from BP. Interesting, given the fact that it's potentially a takeover target.
Well, I was going to say, I'm not sure the number's the biggest story there, given the Elliott stake, the 5% that they've bought as well.
It's the Elliott stake. In fact, the numbers are almost peripheral to the Elliott story. But we've also had Unilever this morning. Not a particularly great market reaction to their numbers. We've also had Barclays' latest numbers, and obviously they're a precursor to Lloyd's next week, NatWest tomorrow, on Friday, and the rest of the banking sector. But for me, I think the picture's relatively positive. I think when it comes to company earnings, I mean, Barclays shares are down quite heavily today, and in all honesty, I really can't understand why they're down 5%, aside from the fact that you could argue that they're 50% up from where they were in August last year. So essentially what we're seeing is a little bit of profit taking on the back of the fact they kept their guidance unchanged. They still beat on profits by 24%. Revenues were good. They were pretty much above expectations for the overall yearly numbers. It's just I think there was some disappointment around guidance. Unilever, obviously, again, spinning off the ice cream division. No puns, please.
No, I've done those. Sadly, we weren't recording. But
no, sadly we weren't recording. But I don't want any more of your scoop puns or anything like that when it comes to Unilever. But I think that again speaks to the fact that they're looking to spin off the primary listing for that in Amsterdam and not the UK or the US. So, I mean, obviously that is extremely disappointing, I think, from a domestic market point of view. But also, I think the fact is that the reaction seems somewhat overdone. When you actually look at the Unilever numbers, they're fairly positive, I think, in terms of growth over the course of the past 12 months. And potentially going forward, they haven't downgraded their growth expectations. They've just suggested some sort of doubt about the outlook for 2025. So, again, I think this is typical of an outsized market reaction to numbers, which by and large, while not great, aren't bad either.
Yeah, no, I think you're absolutely right. And I think what you said in terms of Barclays is spot on in terms of, the stock's priced in a hell of a lot of good news anyway. It is probably a case of the market was looking for maybe a bit of a guidance upgrade. And also when you've got something that is kind of priced to perfection, it doesn't take a lot in terms of a negative catalyst to move that, the other way. But I think
the shares are at 12-year highs.
Exactly, and I think it's a short-term blip in a longer-term uptrend. But it is going to be interesting to see how some of the other banks report in terms of, as you mentioned, Lloyds, NatWest, HSBC coming up next week as well. So it's going to be interesting there. But of course, there are a few.
We'll talk about that in a minute.
Oh, go on. All right.
No, seriously. But I just didn't want to cover too much. I was talking about this week. But absolutely. But go on. What were you going to say?
Well, no, I was just going to say there are a few kind of idiosyncratic issues going on there. Obviously, there's the whole long-running thing around HSBC of, are they going to spin various bits of it off? Are they going to focus more on Asia? Are they going to separate the London UK part of the business? And then, of course, Lloyds, you've got you've got the motor finance problem, which is all still ongoing, and then you've got this potential tax liability as well in terms of the Irish business.
Yeah, so let's park that for a minute. Let's talk about BP.
Go on.
Because I think BP, I talked about this at the end of last year, how the fact that you've got Shell, you've got ExxonMobil, you've got Chevron, all of these oil companies have performed way much better due to the fact that they ditched their focus on renewables, not totally ditched it, but what they've done is they've essentially said, look, we're going to focus on what's profitable for the time being, which is essentially what they're supposed to be doing for shareholders, not virtue signalling their green credentials to anyone and everybody. Ultimately, they're a business and they're there to make money. And ultimately, there's still this legacy of the Bernard Looney CEO tenure, which the new CEO seems rather reluctant to shrug off. He wants to have his feet in both camps. Ultimately, that's done nothing for BP's share price. Yes, there are legacy issues, obviously Deepwater Horizon being one of them, but there is absolutely no reason why BP should be focusing on its sort of renewables business, where the margins, it's not making any money to the exclusion of its oil and gas business. And their trading update this week was pretty poor. I mean, even by oil company standards, it was. I would suggest it's pitiful. So I think the hope is that Elliott will basically shake up the board. Certainly seeing that in terms of how the share price has performed over the course of the past of this week, but it's only really back at the levels it was back in July last year. But if you look at where it was, say back in 2019 or 2020, it's still well below the levels that it was, at its peak back in 2006.
Yeah, and I think that's probably one of the reasons why Elliott have looked at this, and it's kind of an obvious target for an activist investor. You look at where the shares are trading, massively below prior highs. You look at how they're trading in comparison to their peers, and as you said, it's not only the big oil firms in the US that have massively outperformed, but even Shell have left them for dead. And also you then go, well, what's the turnaround opportunity? Well, it's easy. You just put real pressure on them to really pivot away from the renewables sector, which is clearly very cost intensive and not making them any sort of return, and go back to oil and gas, which is your bread and butter, and rebuild the business and focus on what you should be focusing on, arguably. So it does make sense why they've come in. It makes sense why the market has reacted positively. I can't remember the exact date now, but BP do have an investor day towards the back end of the month.
26th, I think.
Is it the 26th?
It's around about then.
So obviously you'd expect the board to outline more of a strategy around what they're planning to do there. But I don't think that's going to, send Elliott on their way. They are going to be pushing for some significant change, almost certainly in terms of personnel as well as in terms of focus for the firm more broadly.
I mean, here's a number for you. Profits for the oil and gas division in 2024 fell from $14 billion to $3.57 billion. I mean, that's a collapse in profitability. And you can't just blame that on the decline in oil and gas prices.
No, absolutely not.
You simply can't. And it sort of leads me back to a conversation we had at the end of last year about Shell moving their listing to the US. Could BP move its listing to the US, given the fact that essentially, I think there's a case to be made that potentially it's being undervalued here in the same way that Shell is?
Yeah, potentially. I reckon now that we've got Elliott involved, there's probably a bigger chance of BP being the one to move than Shell. Although having said that, if one goes, then the other is not going to be far behind, you would imagine. But yeah, they're going to be looking for any way to get value out of it that they possibly can. If that means moving the listing, they're not going to have any qualms about doing that.
I mean, what does that say about the UK? BP, British Petroleum, as it used to be, having its primary listing in the US. I mean, that would be an absolute disaster. I mean, I can remember when BP bought Amoco back at the end of the 90s. The UK company bought a US multinational, and we've gone full circle.
Yeah, I would love to know when the last time was that happened.
Yeah.
In terms of UK firm buying a decent-sized US competitor, you're probably measuring it in decades, I would imagine, at this point.
Certainly, I mean, I'm sure one of our listeners will probably, correct me.
I'm sure they will.
if we're wrong on that, but it's certainly, the fact is, it's probably rarer than hen's teeth, which is probably why I can't remember it. So I mean, that's covered this week's, and also I think we had a fairly positive update from Barrett Redrow earlier this week as well. The house builder. They suggested some degree of optimism for 2025. So, for all the doom and gloom, I think there are pockets of optimism out there. I just think you've really got to look very closely for them. And I certainly think there is a case to say that the UK market is cheap relative to its peers. And, there are some bargains to be had out there. And certainly I think the reflection of the FTSE 100 is starting to reflect that. And I think the performance of the banks next week, and we're going to move on to that, will hopefully further reinforce that optimistic outlook. But before we get on to that, we talked about CPI. We've also got wages and unemployment next week. And obviously in the last set of unemployment numbers, I know you're sceptical about them, but I think, sort of reading between the lines, hiring is slowing. So that's not encouraging. But also unemployment is edging up. It's at 4.4% for the 3 months to November, I think, in the numbers that were released last month. I think the danger is that number could continue to edge higher in the coming months. And wages actually went up to, was it 5.6%?
It was, yeah. It was both regular pay and including bonuses at 5.6, yeah.
Yeah. So that's not going to be good news for the Bank of England if we're sustained at that sort of level. And I think while that is potentially optimistic in terms of consumer spending, are you going to spend that potential surplus if you're worried that you're going to lose your job?
That's exactly the point that I think is going to be the big drag on demand, because you have seen a massive decline in consumer confidence. You've also seen a considerable decline in business confidence. And you're absolutely right. If you are getting a pay rise of any sort, which is likely to be smaller now as a result of the NI changes, you're likely to put that in your back pocket or tuck it under the mattress and save it away for a rainy day, as opposed to going out and buying a big ticket item or whatever it may be. I think just more broadly, the labour market is interesting. That the trend is clearly one of a softening employment backdrop. That, yes, there are issues with the ONS data, we know that, but even if you look at some of the other surveys, everything is pointing in the direction of lower employment, higher unemployment. I think the big sort of question that I've got is, over the last kind of 6 to 9 months, you've almost seen a bit of a two-speed labour market, where those who are in employment stay in employment, and businesses, generally are holding on to the talent that they've got. But those who are not in employment are finding it hard to get into employment because businesses don't want to take on the risk of hiring new people. They're just happy kind of keeping hold of the people that they've got. And I think the question for me is, do we get to a sort of tipping point in the UK economy where the labour market moves from this kind of slow and steady softening but relative stability to a point where actually those businesses who have been holding on to people for 6 months or so go, we can't afford to do it anymore, layoffs, and that's when we have a potential real issue on that.
So you're essentially talking about, you've got a seesaw, right? And it's, at the moment, it's equilibrium. You've basically got a balance between supply and demand in the hope that economic growth picks up. And at some point, there's a tipping point where suddenly it does that. It
doesn't. Yeah, exactly.
And when I say it does that, for our listeners, what I've done is I've drawn a straight line between my thumbs, and then I've moved my right thumb down and my left thumb up in a manner of a seesaw. Essentially, I think that's essentially what we're talking about at the moment. We're in a bit of a sweet spot when it comes to unemployment and firms hanging on to their staff. But at some point, unless we see a significant pickup from what we've seen over the last 6 to 9 months, or 6 months at least, then we could start to see, well, how long can we afford to bear the cost of employing these people if we're not seeing a pickup in demand.
Yeah, you're absolutely right. And I think, the other indicators that we're going to get next week are going to be important. And I think one of the big things to watch is retail sales. We had a big decline in retail sales if you go back to November. The hope was that was, effectively people were pushing back their Black Friday was a little bit later. Also, people were going to do all their Christmas shopping and spending in December. Well, then sales fell by 0.3% on the month in December as well. The picture for the UK consumer, and there's no consensus for the January data just yet, but the picture for the UK consumer is a relatively bleak one, and it speaks to what we were saying a moment ago about people really looking to tighten their belts and potentially battening down the hatches for what could be to come.
How do you explain the 0.4% expansion on a monthly basis of UK GDP? Because services largely drove that, and yet when I look at the retail sales numbers for Q4, obviously minus 0.3 in December, November was revised down from 0.2 to 0.1, and October was minus 0.7. So, I mean, it was a disaster for UK retailers, and yet for some reason, UK GDP month on month in December, 0.4% expansion. I mean,
Yeah,
I know the answer to this, but I'll be interested to hear your interpretation.
Well, I've got to admit, it is a bit of a head scratcher. I personally don't tend to place too much weight on the monthly data, but certainly if you look at the quarterly data, which was the Q4 figures, and again, everyone's focusing on the fact that the economy grew by 0.1% over the 3 months from October to December on that fourth quarter. But if you dig into the data, what you actually see is that private consumption in Q4 was completely flat, which makes sense given the retail sales numbers that we saw. Capital formation, so effectively business investment, that fell by 1% quarter on quarter. So that's a big decline. What actually delivered that 0.1% growth in the fourth quarter of last year was government spending, which rose by 0.8% over those 3 months. So actually, even that, you dig into the fundamentals of the economy and you go, this is still pretty grim, to be completely honest with you.
So I'll tell you where the December boost came. Came about because of an increase in state spending, notably in the services of health and social work. So we did see hospitality activity pick up, with accommodation and food services rising 0.4%, which is somewhat ironic since the Chancellor's budget measures will, when they kick in, will hit those sectors the hardest. But here you go, why not kick someone when they've just had one of their best quarters or best months in a while? But retail activity did struggle. So, as you rightly said, it's government spending. So, I mean, it's somewhat rather counterintuitive. Yeah, they're good numbers, and politically, it plays well. But public spending relies on private sector activity to generate the revenue so that it can pay for itself.
Yes, exactly. The Treasury does not have a proverbial magic money tree.
No, it doesn't. Despite what some politicians and activists would have you believe, there is no magic money tree anywhere.
No,
it eventually
you're
all has
right.
to be paid back eventually, whether it be by us, by our children, or by our grandchildren.
Yeah, and also just as a broader point, that, as you absolutely rightly say, that degree, government spending can't prop up economic growth forever. And then you look at the economy going into the remainder of 2025, the labour market is slowing and softening, as we said. You've got the potential for tariffs to be thrown on the UK at literally any minute of the day, depending on what Trump decides to post on Truth Social.
I'm less concerned about that. I think for the UK, I'm not overly concerned about tariffs.
I would agree, because we've obviously got a heavily services
exactly that
oriented economy, but I think the issue is it's going to be, if they were to eventuate, it's another hit to confidence, which is already incredibly low. It's not going to take a lot to make people even more pessimistic than they already are.
Yeah, but I just think the average UK consumer couldn't really give a monkey's one way or the other about tariffs. At the end of the day, they're worried about paying the bills at the end of every month, and if they got more money in their pockets than they thought they had at the beginning of the month, they may spend a little bit more. Tariffs for me are neither here nor there. But in terms of business confidence, yeah, you're right. But, I sometimes think the tariffs element gets a little bit overplayed because the EU levies tariffs all the time. No one talks about that.
Yeah, that's very true. That is, although that may come back to bite them when
Yeah.
these reciprocal tariffs come in,
Well,
they're
yeah,
suddenly
indeed.
going to learn that one the hard way, I think.
Anyway, I mean, obviously, we've talked about retail sales, we've talked about unemployment, we've talked about wages, and we've talked about CPI. We've also got Fed minutes next week.
Hmm.
Given the fact that they kept rates on hold, given the fact that inflation numbers this week have been slightly hotter than expected, and given the fact the labour market still shows remarkably resilient, why is the dollar not higher? Why
Well,
are yields not higher? Because the Fed's not going to be cutting anytime soon, whereas the Bank of England probably will be, and so will the ECB. So what's going on?
to be honest, mate, I mean, I'm asking exactly the same question. I mean, I would argue the dollar index should be trading nearer 110 than the 107 that it's currently trading at, and cable
Mm,
should be nowhere near 125, which is
yeah.
roughly where we trade when we start to
And euro
record.
should be near a parity.
Yeah, or down that way at the very
Yeah.
least. I mean, I think it's very clear from the data that we've had just over the last 4 or 5 days. For those who are unaware, we had a really decent January labour market report. Yeah, headline non-farm payrolls was soft at 143,000, but we had a big net upward revision. Unemployment came down to 4%. Earnings rose 0.5% on the month. We then had hot inflation figures for January, which came out on Wednesday. Core CPI rising by 3.3%. There's nothing in the data that says the US economy needs a rate cut, let alone multiple rate cuts, as President Trump seems to want. And actually, Chair Powell was again very clear on this front in his congressional testimony this week, basically reiterating that the Fed are in absolutely no hurry to take rates lower. They're going to watch the data as it comes in. If they see progress on inflation, then they might deliver another cut towards the back end of this year. But for now, their default position is to sit on the sidelines. And absolutely, I agree with you. Based on that pure monetary policy divergence alone, suggests the dollar should be a lot firmer. I guess the one thing that markets, going back to that issue of tariffs, I think that is the market's focus at the moment. We've spent all week going, when are these reciprocal tariffs going to come in? In fact, this issue was first raised on Friday last week after the jobs number. We're sat here at 3 o'clock on Thursday afternoon, and those tariffs have still not been put in place. So I think actually some of the move we've seen is probably a little bit of a relief rally in some of these other G10s. But absolutely, once the market moves past this issue of trade, then you would expect some fairly significant upside in the dollar, because that idea of US outperformance, which was there throughout 2024, it's there again in 2025.
And I also think that an awful lot of it's already priced. So people are expecting tariffs. The bigger question is whether or not they get them. And if
Yeah.
they don't, then we could actually get a kick higher in stock markets. Because if you look at US markets, yeah, S&P's made new record highs and what have you. But it's been broadly trading sideways for about the past 3 or 4 months. So we're sort of like in the waiting room, if you like, the tariffs waiting room. Will we get them? Won't we get them? If we get them, how much will they be? Who will they hit the hardest? Yada, yada, yada. So I think for me, we're in the waiting room. And ultimately, I think the next few weeks should be fairly instructive as to which way we break. But I'm not overly bearish when it comes to stock markets, even at these elevated levels for the US. You basically have to trade what you see. And what you see at the moment is US markets are in a range. You're getting wild moves in some of the Magnificent Seven, something that we haven't talked about. And I think we probably will in a subsequent podcast, is obviously NVIDIA and the risks that DeepSeek poses to it, or whether or
Oh
not
God,
it's
I've completely forgotten about that.
or whether or not that's just another, what I would call, throwing a dead cat on the table just to see what gets shaken out. Whether it is a bona fide alternative to an AI solution over and above the amount of money all these big US companies are spending on it. Whether it's a cheap and cheerful Poundland version of AI, I don't know. We don't know, do we? Don't
No,
know enough
we've
about
got
it.
no idea.
But it's given the markets food for thought. Is all this money that we're spending on AI actually, worth it? Or have basically China stolen a march on us? So, we'll just have to wait and see on that.
Yeah, indeed, and as I mean, things have moved so fast. I'd completely forgotten about the whole deep seek thing, but we did see that big knee-jerk move lower in risk that's pretty much faded now.
Yeah.
But I think it's just led participants to look perhaps a little bit more critically and a little bit more skeptically on this huge AI capex that has been going on, because it has questioned that kind of fundamental assumption of, do you need to just go and buy as many computer chips as you can to get the best AI you can, or is there a sort of more efficient way of doing it? But this is something that's going to rumble on for weeks, if not months more. It's not something we'll get a quick and easy answer to.
Yeah, I mean, I only got back from the States last Friday. So obviously I missed an awful lot of the Magnificent Seven results. But one other thing that really struck me about it was this. Now, you're a big US multinational, and Trump's just come into office in the White House, wants to get the private sector involved in capex, investment, and all of that stuff. And when I was looking at Alphabet's results, Google's results, this number really struck me. The company said it plans to invest $75 billion as it looks to expand on its AI capabilities, with $16 to $18 billion coming in Q1. Now that's a huge chunk of change, right? Is it any wonder the US economy is doing an awful lot better than pretty much everyone else when you've got companies like that who are not afraid to throw a whole lot of money at something that at the moment, okay, it's a burgeoning industry. It's not a fully evolved, it's fully developed industry.
It's still ultimately speculative.
There's no guarantee.
I guess the crux of it, as you say, there's no guarantee that this is going to pay off.
No, exactly. But why do they do it? Why do they do it? Because they're incentivized to do it. The government gets out of the way.
Yeah. No, you're absolutely right. And of course, it's not just Google doing it or Alphabet doing it. All of the Magnificent Seven are doing it, and actually companies outside the Magnificent Seven are doing it as well. And even you've got the federal government getting involved with the whole Stargate project that they've been talking about.
Yeah. So why can't our current government, sort of do stuff like this, incentivize business, treat businesses as partners, not as a cash cow to be milked.
If only, mate.
If only. Anyway, moving on. Rant over. Okay, so we've also got public sector borrowing next week. Again, that was a pretty grotty figure for December. Okay, there was a number of one-off items in that. But I think the January numbers could be instructive, because obviously there generally tends to be a surplus for January because of, basically the end of the tax year, and that's the final deadline to submit your tax returns. And last year saw a big jump to, I think it was around about 15.6 billion surplus, which is, I think was a record high.
Yes, I think it was.
Surplus receipts in January. And I think a large part of that was because of various tax changes. An awful lot of people brought forward their tax payments and what have you. It'd be interesting to see if a similar thing plays out in these latest January numbers. But again, this is just a one-off. It's not going to be repeated, and that effect will eventually dilute to the point where it'll slow to a trickle.
No, you're absolutely right, and also, as you say, it's a one-off. It doesn't alter the broader trend.
No.
And I don't think we can take, too much solace from the data, because, as we were discussing right at the start of the recording, headroom's gone. Fiscal headroom's gone. Whether January borrowing data is better or worse than expected, ultimately, it doesn't change the situation particularly much, in that we are still in a situation where the Chancellor needs to balance the books, proverbially speaking, and the way that is likely to happen is through government spending cuts, because she's pledged not to raise taxes. So if we take Rachel Reeves at her word, then it will be government spending that is trimmed in those departments that are not safeguarded.
Right. Okay. So that's the data dealt with. Let's look at the numbers that are due out. We talked about HSBC. You talked about the potential calls for a split between the Asia operations and the rest of the bank. I think the pressure for that will have subsided somewhat. I mean, we do know that Ping An, which is one of HSBC's largest Asia shareholders, has been pushing for a split for some time. Obviously, there are political considerations at play with respect to China and pretty much everything else. But, the share price is back at levels last seen pre-financial crisis. So, in terms of shareholder returns and value, it's doing really well. They announced a buyback of $3 billion, bringing the total buyback this year to $9 billion. The new CEO is keen to drive productivity in both regions, and ultimately both regions are profitable. Yes, it does make most of its money in Asia, but the UK operation is still really profitable as well. The return over the last 9 months for the UK bank has been $5.56 billion out of the total of $30 billion year to date. So I suppose you could make a case for them spinning it off. But, how would they do that? I mean, it took them long enough to basically absorb Midland Banking when they took it over back in, the early part of this, early part of the noughties or whenever it was. So sort of spinning it back out again, it's likely to be a fairly costly affair. I don't see the rationale for it unless it becomes politically expedient to do it.
Yes, I think they are, well, certainly the political angle is one reason that they could do it. The other thing that is on my mind, it's probably not as big of a driver, but it's worth keeping on the radar nonetheless, is the regulatory aspect in terms of the relatively capital intense nature of having a UK retail bank. This is also something that, and they flat out denied these reports, by the way, but this is also something that Santander have been reportedly looking at. Obviously, I know they're not listed here, but the FT have been reporting a lot that they may ditch their UK arm because it's too capital intensive for the rest of the business.
Can't see them doing it though. It's too expensive to do.
I think it would be too expensive to do as well. And I think it's the same would be said for HSBC. But nonetheless, that is the potential other reason that these banks would look to go down that path, I think.
I think you've got to make a trade-off. How much value will it unlock relative to how much it will cost to do? And I don't think the numbers will potentially add up. Who knows? Santander took over Abbey National, didn't it? I remember Abbey National back in the day. But yeah, interesting point. I think both scenarios at this point in time are unlikely.
Yes.
But I think it's just Anna Botin's way in the Santander case of just saying to the UK government, ease up on the regulation a bit, please, and maybe dial down, the capital requirements. I think they could probably do that, but I'm not a big fan of making banks less resilient, given the muscle memory of 2008.
Yes, you're absolutely right. We could talk about that all day, but we probably shouldn't, because that could get very boring very quickly.
which brings us on to Lloyds Bank, because you may remember we had a conversation a few weeks ago about could Lloyds Bank go to £1 when it dropped to 50p, and I said to you at the time, I felt Lloyds was underpriced, even accounting for this Black Horse Finance stuff. Now, since then, we've rebounded, and we're now back at the levels we were pre the announcement of that mis-selling, or whatever you want to call it, the Black Horse Finance thing. And I still think that it is still undervalued. And, the fact that we've managed to rebound, despite the fact that this appeal court thing isn't until April, suggests that Lloyds will probably be able to ride this out.
Yeah, potentially. Sorry, I thought there was more coming there, mate.
No.
No, that was a very good call. As you say, we have rebounded since. The market clearly has some degree of faith that they are going to be able to get over the worst of this auto finance issue. Obviously, there's still a long way to run on the retail side of that. And speaking of which, there is still a hell of a long way to run until they get back to £1, precisely 44 pence. But nonetheless, the momentum is favouring the upside at the moment.
Well, my next target for Lloyds is the 2019 highs when the Conservatives won that 80 seat majority. It went up to 69.9p. It's not been back there since. So for me, I think that's the next near-term objective on a technical basis, on my crayon basis, that's the next key level for me. And to my mind, I think barring any mishaps, we are now back at the highest level since December 2019. And I see no reason, given the fact the bank is more profitable, more efficient than it was then, why it can't go back there. For me, it goes back to what we were saying a few weeks ago about, shares can remain underpriced and undervalued for a very, very long time, and until such times as the market wakes up to the fact, well, actually, these look cheap. It's about time we took them higher. And then suddenly the momentum completely shifts and we go the other way.
Exactly that, mate.
So hopefully that will be one of those occasions. You never know. I've been wrong before and I'll be wrong again.
Well, we all are. That is the name of the game. You can't be, none of us can be right 100% of the time. And actually, it'd be pretty bloody boring if we were, I think.
And the trick is knowing when to be wrong.
Exactly. And if you are wrong, being wrong quick.
Yeah, exactly. So, in terms of what's due next week, obviously Lloyds Bank and HSBC are the big ones. We've also got a couple of US ones. We've got Walmart, which obviously is the US's biggest retailer. And if retail sales in the US are any indication of consumer spending patterns, then Walmart generally tends to do well, and they have been doing well. They had a blowout quarter in Q3. They upgraded their guidance for Q4. Net sales last fiscal year came in at $642.6 billion, and they're looking to come in well above that. So it'll be interesting to see whether or not, having raised their guidance for Q4, they're able to meet that guidance, and more importantly, whether or not they are as optimistic for 2025. One of the things they said in the Q3 earnings call was that tariffs could have the potential to harm its margins and add to cost of living pressures. So there is that. But when I was in the US, I went to places like Cheesecake Factory, Olive Garden, Denny's. It's always a go-to place. Great coffee. They're always full.
Really?
They're always full. Yeah.
Well, that bodes well in itself, just purely anecdotal evidence. But I think your last point is the most important. When they've raised guidance, they now need to meet that guidance, firstly. But also the market's going to be looking for a read into the year ahead. Not only in terms of the Walmart stock itself, but the consumer more broadly. They are, as you said, the US's biggest retailer, so they are going to be used as a barometer of consumer spending more broadly. You'd expect the figures to be okay, given the consumption indicators that we've had. The question is, can they keep delivering?
And the shares are at record highs, so the bar is high as well.
Exactly.
Unlike its closest competitor, Target, which basically hasn't been doing well, and where probably expectations are lower, but they're not due out, I think, for another couple of weeks. I don't think they're due out until the beginning of March.
Yeah, you're right.
Anyway, that's pretty much it, I think, for this week. One thing I would say to you is we talked about Shine and the IPO in the early part of this video. Richard Berry has written a very good piece on the Good Money Guide website in the investing section about Trump tariffs take the shine off buying Shine shares in the IPO.
God, hang on. You say my puns are bad.
It wasn't mine. So, this IPO could happen in the first part of this year. And whatever your feelings about it, why they're doing it here in the UK, it's definitely a plus for the UK market. You've got potentially $40 to $50 billion, maybe, in and around that money coming into the UK market if Shine finally gets its equity market off the launch pad. So it'll be interesting to see how that plays out. And you can read all about it on the Good Money Guide website. And I think that's it for this week. We've gone on for about, that's pretty standard. We got through a lot, Michael.
We covered a lot of ground there.
47, 48 minutes. So plenty to get our teeth into. Anyone has any questions that they want to ask Michael or myself, then obviously stick them in the comments section on YouTube, because I'm pretty sure that the comments section is enabled and we can address them there. Trying to look at anywhere else as to what we could be talking about next week, but I can't really think of anything. I think we've pretty much covered all the ground. So
I think we have.
I think on that note, wish you all a good weekend, and look forward to seeing what next week brings, and whether our pessimism or optimism barometer, which way it's lent. as we look and digest the numbers that we talked about this time next week. So on that note, goodbye from me, and it's goodbye from him.
See you later.